How many lost decades do you think the stock market has had over the last 100 years? 1, 2, maybe 3? In other words, if you could randomly select 1 year out of any of the last 100 years to begin your investing, what are the odds that you would end up with less than what you started with 10 years later? If you're anything like me, the answer to this question might shock you. And if you don't know who I am, my name is Joe Brown. I'm a former stockbroker. I spent years advising the top 1% on how to manage their wealth. And after making enough money to leave that corporate world behind, I turned my attention to teaching people financial strategies that exist outside the mainstream, things you'd never hear from your financial advisor or from your stockbroker. And today is a perfect example of that, because you'll hear time and time again from the financial mainstream that the only thing that matters is just keep buying, that time in the market matters more than timing the market. And I'm gonna show you why that's just not true. Now here you will see a chart of the S&P 500 going back all the way to the 1800s. And you can see over a long enough time horizon, yeah, the stock market does always go up. But that knowledge does you no good if you need to access your money. Let's say you need to retire, and for the next 10 years, the stock market does nothing but go down. It doesn't help you that over a long enough time horizon, eventually it'll recover. What matters to you is that you have access to the wealth when you need it. And so I wanted to find out over the last 100 years, exactly how many lost decades there had been with the stock market. By the way, if you are worried about the upcoming election and some of the political chaos that it might cause, and you are looking for a way to protect and even grow your portfolio as this all plays out, then I want you to write this date down. Sunday, November 3rd at 7 p.m. Eastern time. That's the day I'm going live on Zoom to detail something I call the election chaos trade. This is a special type of asymmetric trade that has historically soared in the months following an election. In fact, during the last election cycle, it produced some of the biggest gains yet. In this election cycle, I believe it could soar even more. That's why I'm going live on Sunday, November 3rd at 7 p.m. Eastern time to tell you all about it. I'll detail things like how this trade would have made money regardless of the markets going up or down, how this trade had the potential to pull in massive performance in every election going back to 2004. The key to making a strategy like this work out in your portfolio. And finally, why November 4th might be your last chance to get in. If you're interested, simply click on the link in the description below and register for the event. Attendance is free, but spots are limited. Last time I did an event like this, we had nearly 4,000 people register, so we might not be able to fit everybody onto the call. That's why it's a good idea to register now, bookmark it on your calendar, and show up early. So to do that, just click on the link below, and I look forward to seeing you there. For example, take a look at this chart. We are looking at the year 1927. So if you had invested your money in 1927, at the beginning, you would have seen your money go up in value quite a bit. The Great Depression would start, the stock market would crash, and then 10 years later, you'd be left with a little bit less than where you originally began. In other words, you would have a lost decade. Now, clearly, if we also plot the year 1929 on this chart, it's going to be worse. In other words, if you had invested in 1929, 10 years later, you'd be down over 50%. Now, some years do very well. If you would have invested your money in 1991, you would have seen a monstrous return over the next 10 years, ending up with about 340% more than where you started. Now, in case you're curious, big shout out to @DharmaTrade on Twitter, who created this tool for me. This tool allows me to choose any year from the last 100 years and see what the 10-year return was following that year. And this is what the chart looks like when you plot every single year since 1927. This gray line at the top is 1991, which means if you would have invested your money in 1991, 10 years later, you would have ended up with the largest 10-year return of any year of the last century. As you can see, some of these lines start off dipping down quite a bit and then recover later on, whereas some of these lines start off really good and then they decline later on. But overall, you see an average that sits somewhere between the record high performance for a decade of 1991 and a record low performance following 1929. Now, clearly, There are more winning decades in the stock market than there are losing decades. But pay attention to this straight red line that is cutting through all the chaos, because this is the zero line, which means any of the decades of stock market performance below this red line are losers. Just to be clear, that means if you invest in the S&P 500 in one of those years, after 10 years of letting your money just ride, it is worth less than it was when you originally invested. This isn't even including inflation. This is just raw price performance. On the other hand, this is also not including the dividend income that those stocks would provide you. So keep that in mind. That's going to be important. We're going to talk about that in a moment. So if we want to clean this chart up and just look at the losers, we can do so here. And I left 1991 on the chart just so you can get an idea of the best performing year compared to the years that have a decade of losing performance. Now, if you're anything like me, you're taking a look at that chart and thinking, man, there are more losing decades in the last 100 years of stock market performance than I initially thought there would be. If you would have asked me before I looked at the data, I would have guessed 2, maybe 3 years. I would have guessed 1929, somewhere in the 70s, and then maybe somewhere in the late 90s. But if we zoom in here at the very end of this chart and take a look at all of the decades that have negative performance, we can count up and see there are 11 decades. Keep in mind, this is less than 100 years. This goes from 1927 through 2024. So in 97 years, there are 11 lost decades. That's a little over 11% of the years of the last century would have resulted in you winding up with less money after a decade of investing than what you started with. Earlier, I mentioned the common mantra that you will hear by the financial mainstream, that it's not about timing the market, it's about time in the market. That is a verbal sleight of hand, because time in the market still requires you to time the market because you need your wealth to be there for you when you need it. Everybody understands that the stock market might have losing years, that the stock market might go down for a few months, heck, even a few years. But everybody's told over a long enough time horizon, the stock market always goes up. Apparently, they just don't want you to look at the data to understand that even a decade is not long-term, or at least not long-term enough for stocks to always go up. And it's not even enough to just look at the beginning of the decade's performance. If you take a look at this gray line here, this is the 10-year time period that started in 2015, which means it will end its decade in 2025. This blue line here is the one that started in 2016, which means that it's going to end in 2026. Here, this blue line is 2017. Here, this red line is 2018. And you can see many of these lost decades did not start off as losers. Many of them started off back here as winning decades. So what are the takeaways from this? Well, takeaway number 1 is that the odds are a lot worse than you think. If you think you need $1, $2, $3, $4, $5 million in your nest egg in order to retire, and you are counting on the ability to sell some of your shares at their current value or higher as you retire in order to maintain your lifestyle, you are gambling with your future. There is a worse than a 1 in 10 chance that you are retiring at the beginning of a losing decade, which means you are going to be selling your assets at a lower price than the one in which you retired. That means, by definition, that you will not have as much to live on and your money won't go as far as you thought it would. Now, if you like gambling and you like taking those risks, more power to you. Just understand that you have a little bit worse than a 1 in 10 chance that you are retiring at the beginning of a losing decade. Takeaway number 2. You should not rely on only selling shares in order to retire. When we look at all of these lost decades, which returned less than 0% after 10 years, we're looking at the absolute price performance only, which means, let's say you've got $2 million in stocks and you're gonna sell shares every year in order to pay for your retirement. That could turn out to be a bad deal. However, if you have $4 or $5 million in stocks and you are able to live on just the dividend income that those shares produce for you, then you are in a much better position because you don't care about the share price. If the share price goes down and you end up in a lost decade, you don't care at all. You're just taking the income that those dividends are paying you. You're using that for your living expenses. This means you may need a larger nest egg than you originally thought in order to stop working, but it also means you'll be in a much better and much safer position. Takeaway number 3, you should have more diversification than just stocks. Nobody should ever be only all in 100% equities. Now, the financial mainstream is going to tell you that you need to have 60% in stocks, 40% in bonds, or some variation of that. And that is even stupider because a bond is guaranteed to give you income less than the rate of inflation. Further than that, you're taking on default risk that the bond just doesn't pay you back, which means you are taking on the guarantee that you will lose money by investing in bonds, at least as far as you measure in purchasing power rather than nominal dollars. But you should absolutely have uncorrelated positions in your portfolio other than stocks, things like real estate, like cash flowing real estate, things like gold, things like Bitcoin. That way, when your stocks have a losing decade, you have other assets to rely on, especially other assets that are paying you income. And the final takeaway is that you need to spend some time giving yourself some financial education so you know a little bit more advanced investing and trading techniques so you are not vulnerable to lost decades. Even something as simple as selling covered calls so you can produce some income on your stocks. Buying some protective puts so in the event of a stock market crash, you don't lose money, you make money. If you'd like me to help you apply ideas like this to your investing so you can grow your portfolio in the good times and in the bad, click on the link in the description below. As always, thanks so much for watching. Have a great day.